Hello and welcome to Accounting 201. Today I wanted to go over how to create journal entries and how to analyze specific transactions that will facilitate creating these entries. What you see in front of you is a template that I'm using to create the journal entries. It has a date, it has the account titles and explanation. This one here is going to be the payroll register or the posting register, which we're going to ignore for purposes of this demonstration. And then you see a debit and credit. I am right now going to make these cells a little bit bigger to accommodate the numbers that I will put in here. But I would like to go over this because I think will be very useful to you as you're creating your journal entries for your project as well as for your problem sets that you'll be working on throughout the remaining term. So what I would like for you to do when you're looking at these transactions is asking yourself the question, if it were me, if I was doing this, what exactly am I accomplishing with this particular transaction? Make it a little bit more personal so that it'll be easier to understand and not so lofty and difficult. So on the 1st of May, I'm going to say May the 1st, and I would probably do better to say 5/1 like that, which is a little bit easier, and I'm going to leave that space blank. It says S invested $90,000 in cash for the company. So basically what this person is doing is investing money into the company. So the company's books will be the entries that we'll be recording. So know which side of the fence you're on. So we are, as a company, receiving $90,000 in cash to start the company. So I'm going to say, if I'm receiving cash, I'm going to increase my cash with a debit of $90,000. Now remember, with these entries, you have to be certain to create a double-sided entry. It's very important to be a double-sided entry, meaning the debits have to equal the credits. So in this case, I've got cash, but I'm going to include that as an investment. So I'm going to put that as common stock because an investment in a company is going to be equity, and in this case, common stock is corporate equity. $90,000. Now the question then becomes is why am I recording a credit to common stock? Equity accounts as well as liability accounts always are increased with credits. Asset accounts as well as reduction in equity are going to be debited. So an asset in this case includes cash, includes accounts receivable, and inventory. So my description is record investment by S variety. So far, so good. Let's try the next one. May the 2nd, the company purchased $25,000 of office equipment and paid $10,000 in cash and signed a note payable for the rest. So one thing we want to say is we have equipment, and it's telling us, and office equipment, as you know, is like any other asset, something that you own and you can use. So office equipment is going to be my asset, and I'm going to record my assets first, or I'm going to record my debits first, and then I'll record my credits. So I'm going to record $25,000 that I received as an asset. Now, also it's saying that I paid cash of $10,000 and I signed a note. A note is an obligation. So you have an obligation to pay this money back. So I'm going to put notes payable. And remember, liabilities are going to be increased because we just incurred this debt, and we're going to increase it by crediting it. And the difference between $10,000 and $25,000 is the 15. Now we already know that we paid cash for this. So I'm going to reduce my asset with the credit. Whoopsie. Can't move too fast here. So in this case, I have recorded the purchase of office equipment. That's essentially what I did. How I did it, I paid it in cash and in a debt, but I still purchased office equipment. Also on the 2nd of May, it says here, the company rented office space for $3,000 for the month. And since we're in May, we can record the incurrence of rent expense. Remember, rent expense is a reduction in equity. When you want the equity to go down, you have to debit. So in this case, rent expense is a $3,000 debit. Now, we did that And it doesn't say that we paid cash, but you can assume when you use the word paid, you are writing a check or paying it in your cash here. So I'm recording rent expense for May. So far, so good. These entries are easy to record when you understand exactly what's occurring and you know some general rules. First, to know what's going on, we paid for rent. The general rule is if you're paying for something, you're actually going to be taking it out of your cash or your checking account. Number two, it says rent expense. It says rent because you are in a facility where you have to pay for the use of something. When you use something, you incur an expense. And in this case, it's rent. So that's how you'll have to think about these transactions. What exactly is going on? Now on May 8th, well, actually, let me go back. On May 6th here, I'm recording the company installed new vinyl siding for a customer and immediately collected $5,000. So if you're doing a service for a client, remember, the revenue that you are going to record is the revenue that you have earned, and you clearly have earned the revenue. So now you can recognize the revenue. But then here you have to also consider, how did you get that money? Did you bill them for it to be paid to you later, or did you actually get money in cash? And it said immediately you collected $5,000. So we have to assume that our cash is going up because our client has paid for services that we rendered to them. And we're going to provide this, and we're going to say services revenue. Again, we're increasing equity. Revenue increases equity, expenses decrease equity. And if we're increasing equity, we're going to record this as a credit. So record sales for customer. Okay, now we're going to do the next entry. On the 7th, I believe, the company paid a supplier for siding materials used on the May 6th job. So I'm going to say 5/7 is my date, and we purchased siding. Now, in this case, we have to think about it a little bit less a little simply. And I'm going to I'll call this inventory of $5,000. No, sorry, $2,000. And I'm going to record credit to my cash for the purchase of inventory. And with the purchase of inventory, supplies. Now, the next entry is on the 8th, and we are officially recording the company purchased a $2,000 copy machine on credit. We did get the copy machine, which is an asset to us, but we didn't pay for it right away. So, and it didn't say note payable. So I'm going to assume office copier is my asset, and the amount is $2,000. But I'm going to put accounts payable because it doesn't give me any indication that we signed a note. The difference between accounts payable is more operational between yourself and a vendor. And a note payable is really a liability that has an interest rate charged attached to it. Here, it doesn't give me any indication of such. So I'm going to assume that we're going to record the purchase of copier on credit. Now, the next entry is on the 9th of May. I'm going to scroll up a little bit so you can see. On the 9th of May, right here, the company completed work for additional customers on credit. Now, they've earned their revenue, but they didn't get the money. What are they expecting? They're expecting some money in return, so that's going to be an accounts receivable. I'm expecting accounts receivable for my client. I earned the money, but I haven't received the cash. And that looks like it's $16,000. Now, revenue is the same thing. I'm going to call it sales revenue. Well, actually, I'm going to be consistent. Services revenue. Of $16,000. And I'm going to just make my little changes here. Nope. Let's get rid of I'm going to get rid of the dollar signs. I don't think I want the dollar signs. So I'm going to get rid of those. There we go. And here I'm going to record sales on credit. And I hope that makes sense to you. I'm going to scroll up a little bit further. And the question now is, the company paid its employees salaries of $2,300 for half the month. This is going to be on the 15th of May. So the employees, we paid them. So I'm going to record salaries. Whoopsie. My computer moves a little fast. Salaries expense. And that's going to be about $2,400, $2,300. And $2,300. And I'm going to record cash because it said paid. I'm assuming if I paid something, I'm actually reducing the amount of money in my bank account. Record salaries paid to employees. And I'm going to go to the next, which is the 17th of May. Company installed new siding for a company and received cash, $2,500. So I received money for the services I've rendered. And I'm going to call this services revenue. Again, I'm increasing my cash with a debit. And I'm increasing my revenue or my equity with a credit. Record services for client. On the 20th of May, I'm going to record the transaction. It says the company received $10,000 payments from customers billed. So we've already billed them. And here is the entry that we recorded when we billed them, right here. We debited accounts receivable and we credited sales revenue. Now let me change this to make it 16,000 because we don't want too many zeros here. We want to make sure all of our entries equal. So if we recorded our sales already, now we're going to collect the money. So we have to reduce the amount of expectation. We're not expecting 16,000 anymore because we've got 10,000 already. So I'm going to record my cash that I received from my clients, and I'm going to record a reduction of my receivable. I'm not expecting 16,000 anymore because 10,000 has already been received by me. Okay, now let's make a couple more rows here. But does it all make sense? When you're recording these transactions, you really have to think about what's going on, because that's going to really help you determine what accounts are appropriate. And then once you know what accounts are appropriate, your job then is to determine if I'm increasing something, if it's an asset, what are the rules for increasing an asset? What are the rules for decreasing an asset? So once you get the accounts set up in your mind, these are the accounts I believe are affected here. Now you have to understand how to make them bigger or make them smaller depending on what the transaction is actually talking about. And so taking it step by step really does help. All right, so now we're going to be on the 28th of May. I'm going to say record payments. On the 28th of May now, we have to record the company paid $1,500 on the copy machine. The copy machine we purchased, let's see, where is that? Right here. We debited the asset and then we credited accounts payable. So now that we're paying that back, we have to remove part of the accounts payable, the amount that we owe. So I'm going to reduce my payable with a debit of $1,000, I believe it's $1,500. And I did that by paying cash. And on the 31st, we have 3 transactions, it looks like. The first one, I'm going to add more lines here because it looks like I have a lot more entries that I have to record. All right, on the 31st of May, we have to record company paid its employees $2,400 for the second half of the period. So I'm going to record my salary expense, $2,400, and I'm going to record a reduction on cash because we paid them. Now they've got their money. Record salary paid to employees. We have another entry that we want to record on the 31st. And that entry is paid the supplier $5,300 for deciding materials on the remaining jobs. So we're going to record inventory. If I can get my cursor to stay put. I'm going to have a little bit more space because it's just easy to see. So I'm going to record my inventory. Gosh, darn, let's go back down a space. And we'll record our inventory. And I believe it's $5,300. And it looks like we paid it in cash. So cash is going away. In this case, we're decreasing an asset and increasing an asset all in the same transaction. Let's look and see what's the last one. Pay $450 for this month's utility bill. So $531. And we're going to record the payment. So we have to record the use of utilities. I'm going to call it utilities expense. We used it. $450. We also paid that bill. We didn't just record the receipt of an invoice, but we recorded the money that we had to pay. So I'm going to record utility bill payment. And here are all the transactions for the month of May. My hope with all these transactions and going over them with you is helping you to think about the transactions a little differently, helping you understand how to differentiate or determine the accounts that are applicable, and then remembered how to recall the rules on how to increase and decrease various accounts. That would be very helpful when you're trying to create journal entries. Thank you very much for your time, and I'm hopeful that this little tutorial will be helpful to you. Have a good day.